The upstream oil and gas company Sound Oil has seen its shares suffer in recent months. The Chief Financial Officer is James Parsons and joins us now. James, welcome. What's the company's focus at the moment?
Well, Jeremy, we, following two acquisitions in 2011, have built up quite a strong portfolio of Italian assets, 17 licenses, and an NPV independently assessed above $1 billion. That's 300 million from discoveries, 700 million from exploration. Now, those are unrisked numbers, but pretty material from our perspective. Our focus at this point is very much about turning that NPV into shareholder value. So that's a well program of 7 wells in the next 12 months, and we're feeling confident about that.
Give us some flavour of the wells that have been drilled in Italy, which is where, of course, your major interests are.
Yeah, that's right. We've got 3 wells, which are really the backbone of our program. The first of those is Nervesa. So this is a 21 BCF gas discovery in the north of Italy, in Po Valley. It is independently assessed at $62 million NPV. We're going to drill that in August. We're fully funded for that, and that's really transformational for the company. The second of those is Strombone. This is likely a drill in December, and that's a 6.5 million oil discovery down south in the Basilicata region, and again, really critical, key transformational well for us. The third is Badile. Now, this potentially is a farm out for us. It's a gas exploration prospect, and again, very excited about that one too.
Your market cap is only $50 million US dollars, which equates to about 36 million pounds sterling. Why are you focused on Italy? I mean, these NPVs represent a significant upside given that current market value.
Yeah, Italy's a very gas-hungry and energy-hungry nation, so they import 90% of their gas, and as a consequence, the gas price is very high. Operating costs are very low, and it's a great place to be for small cap oil as a consequence. What
are the risks, though, to your operations?
Well, similar to other small cap oils, our key risks are getting funding in place as early as possible. Commodity price risk is obviously in there, and we're also naturally wanting to discover hydrocarbons in our key wells, and the failure to do so would be another risk. Now, our response to those risks is really to get funding in early, and we've just achieved that with Nervesa, so we're fully funded on that key well. And also, we've upgraded our technical resource in Rome, which is our key operating hub. Now, you may have seen the announcement, we've recently hired a gentleman called Luca Mededu. He's our sort of general manager and managing director in Italy. He's come from over 20 years' experience with Eni, so we're very pleased to have him on board, and that really helps de-risk some of these key wells for us.
In terms of the spread, as you say, you're dominated in Italy, but you recently announced an abandonment of a well in Indonesia. Now, Indonesia was a major part of your business because it's now relatively small. How much of a setback was this abandonment for Sound Oil? Yeah,
it's important to keep the Kataka abandonment in context. This was one of 3 exploration wells in Indonesia in the Citarum PSC. We've spent net just over $1 million, and actually the prospect isn't lost. The operator, Pan-Orient, is going back to the prospect in May. So abandonment is obviously not something the position we wanted to be in. However, actually the prospect's still there. We've spent only $1 million on this, so it's not material at all, especially in the context of our high upside Italian portfolio.
One of the things you mentioned in the interview just a few moments ago was this idea about making sure you've got the funding coming through. How difficult is it for small caps and the funding issue? How difficult is it in this current environment? And what's your current funding position at Sound Oil?
Yeah, I mean, the last year has really been a tough time for small cap oil attracting equity. We're fortunate enough now to have 8 million sterling in the bank. Now that will fund us through to October, November this year, and also takes us critically through that Nervesa first appraisal well. It's worth saying that we're acutely conscious of the balance here between dilution of existing shareholders and the need for funding security. So we're constantly balancing that, but at the moment we're in a very strong position in terms of funding.
Certainly, I mean, the strong position is backed up by the share trading of some directors. I think 2 of your directors have bought shares in the company recently, both at 1.4 pence. What's the message to shareholders, given this backdrop and the funding and the outlook and so forth?
Yeah. Well, we have an extremely liquid and volatile stock. End of 2010, we were at 1.3 pence. We're now at 1.5 pence. And in between that period, we've been up to highs above 6 pence and down to 1.2 pence. So massive sort of volatility there. What I would say is that our current drill program equates to about 10 pence per share in the success case. So rough numbers, that's 2 pence per share for Nervesa, 4 pence per share for Strombone, and on top of that, should Badile be successful, there's 6 pence per share on a farmed out basis. So a lot of upside and very exciting. And just to be clear, our strategy is to drill the material Italian wells, and doing that will be transformational for this company.
And 2012, what are the big signposts to watch out for this year?
Well, I think it's all about Nervesa, which will be an appraisal well in the summer, Strombone back end of the year, and Badile shortly thereafter. So expect some action.
Good. Okay. All right. James, thanks for joining us. James Parsons there is the CFO of Sound Oil.
This film is for educational and leisure purposes only. Proactive Investors does not provide investment advice. The company is a publisher and is not registered with or authorized by the Financial Services Authority. Please refer to the full terms and conditions on the Proactive Investors website.